everyone, welcome back to Smart Money Reset. I'm Frank. If you've been following the series, in episode 1 we reset your money mindset and built a real budget. In episode 2 we built your emergency fund, your financial safety net. Today we cross the line from saving money to growing money. Here's my honest confession. I waited 4 years longer than I should have to start investing. I kept saying, I'll start when I have more money. I'll start when the market dips. I'll start when I understand it better. You know what those 4 years cost me? Based on historical S&P 500 averages, roughly $30,000 in potential gains. Compounding doesn't wait for you to feel ready. Today I'm going to cut through every excuse, every source of confusion, and show you exactly how to invest your first $1,000, or even your first $50, in 2026. By the end of this video you'll know which account to open first and why it matters enormously for your taxes. 3 real ETF portfolios for 3 different risk levels, how to automate your investing so you never have to think about it again, and the 5 mistakes most beginners make so you can skip right past them. The irony of investing is that it's actually simpler than most people think, but it's made to seem complicated. Let me name the real blockers. Blocker number 1. I need a lot of money to start. False. With fractional shares on platforms like Fidelity and Schwab in 2026, you can start with literally $1. The habit matters more than the amount. Blocker number 2. I don't understand stocks. You don't need to. Today's video isn't about picking stocks. It's about owning the entire market at once, cheaply and automatically. Zero research required. Blocker number 3. What if the market crashes right after I invest? It might. Markets recovered from the 2000.com crash, the 2008 financial crisis, the 2020 pandemic crash, and the 2022 bear market. Every single time. The risk isn't investing during a crash, it's never investing at all. Blocker number 4. I'll start next month when things settle down. There is no settled moment. The research is clear. Time in the market beats timing the market. Every month of delay is compounding, you'll never recover. The solution to all 4 blockers? A system so simple that confusion and hesitation have nowhere to hide. Let me show you. Before you buy a single ETF, you need to decide where to hold your investments. This one decision affects how much of your gains you actually get to keep after taxes. It is arguably the most important financial move for a beginner investor. There are 2 main accounts. Let's break them down. The Roth IRA is the single most powerful investment account available to most Americans under a certain income threshold. Here's the deal. You contribute money you've already paid taxes on. Your investments grow completely tax-free for decades. When you withdraw in retirement, 0 taxes on the gains. 2026 contribution limit. $7,500 per year if you're under 50, $8,600 if you're 50 or older. Income limit for full contribution. Under $168,000 if single, under $252,000 if married, filing jointly. That graph I'm showing you right now. $1,000 growing to $7,600 over 30 years. That entire gain is yours. No tax bill, nothing owed. That's the Roth IRA advantage. If you've maxed out your Roth IRA, or you need the flexibility to access money before retirement age, a taxable brokerage account is your next move. No annual contribution limits. Invest as much as you want, anytime. Full flexibility. Withdraw anytime without early withdrawal penalties. Dividends and capital gains are taxable each year. That's the trade-off. Best for goals shorter than 30 years. A house down payment, starting a business, supplemental wealth. Here's exactly how I prioritize accounts if I were starting from 0 today. 1. First, contribute enough to your 401k to get the full employer match. That's an instant 50 to 100% return on that money. Always take it. 2. Second, max out your Roth IRA. $7,500 in 2026. Or contribute whatever you can right now. 3. Third, invest additional savings in a taxable brokerage account. 401k match. Roth IRA. Taxable brokerage. In that order. Don't overcomplicate it. Before you buy a single ETF, you need to decide where to hold your investments. This one decision affects how much of your gains you actually get to keep after taxes. It is arguably the most important financial move for a beginner investor. There are 2 main accounts. Let's break them down. The Roth IRA is the single most powerful investment account available to most Americans under a certain income threshold. Here's the deal. You contribute money you've already paid taxes on. Your investments grow completely tax-free for decades. When you withdraw in retirement, zero taxes on the gains. 2026 contribution limit. $7,500 per year if you're under 50, $8,600 if you're 50 or older. Income limit for full contribution. Under $168,000 if single, under $252,000 if married filing jointly. That graph I'm showing you right now, $1,000 growing to $7,600 over 30 years. That entire gain is yours. No tax bill, nothing owed. That's the Roth IRA advantage. If you've maxed out your Roth IRA, or you need the flexibility to access money before retirement age, a taxable brokerage account is your next move. No annual contribution limits. Invest as much as you want, anytime. Full flexibility. Withdraw anytime without early withdrawal penalties. Dividends and capital gains are taxable each year. That's the trade-off. Best for goals shorter than 30 years. A house down payment, starting a business, supplemental wealth. Here's exactly how I'd prioritize accounts if I were starting from zero today. 1. First, contribute enough to your 401k to get the full employer match. That's an instant 50 to 100% return on that money. Always take it. 2. Second, max out your Roth IRA. $7,500 in 2026. Or contribute whatever you can right now. 3. Third, invest additional savings in a taxable brokerage account. 401k match. Roth IRA, taxable brokerage. In that order. Don't overcomplicate it. This is the core of today's episode. You do not need 20 different investments. You do not need to analyze earnings reports or watch financial news every day. You need 3 ETFs, or even just one, and time. Here's the framework. 1 broad US market ETF, 1 international ETF, 1 bond ETF. Mix them based on your risk tolerance and how far away your goal is. BTI or FCROX, total US stock market. Exposure to more than 3,500 US companies in one purchase. Expense ratio around 0.03%. This is the bedrock of any beginner portfolio. VXUS or FCILX, total international stock market. Europe, Asia, emerging markets. Diversification beyond the US economy. BND or FXNAX, US total bond market. Lower volatility, acts as a shock absorber when stocks fall sharply. Now, here are 3 ways to combine them. 50% VTI, US stocks for growth with built-in diversification. 20% VXUS, international exposure. 30% BND, meaningful bond cushion for stability. Best for someone closer to needing the money, or someone who knows they'd panic and sell if the market dropped 30%. 60% VTI, solid US equity base. 25% VXUS, meaningful international diversification. 15% BND, light bond cushion. Best for most people in their 30s to 40s who are investing for a retirement 15 to 25 years away. This is Frank's default recommendation for most viewers. 70% VTI, maximizing US market exposure. 30% VXUS, strong international exposure. 0% BND, no bonds, maximum long-term compounding. Best for someone in their 20s with 30 or more years until retirement who can handle market drops without selling. Don't overthink this. Pick the portfolio that matches your timeline. Start. You can always adjust allocations later. That's a 5-minute rebalance once a year. Visual on-screen text. The best portfolio is the one you actually stick with. Dollar cost averaging means investing a fixed amount at regular intervals, regardless of what the market is doing. It completely eliminates the dangerous question of, is now a good time to invest? Let me show you the math. Stay with me. This will change how you think about money. Scenario 1. $200 per month from age 25 to 65. Total contributed from your own pocket, $96,000. Assumed return. 7% annual average, conservative, inflation-adjusted estimate based on SP 500 historical data. Result at age 65. Approximately $525,000. You turned $96,000 into $525,000. The extra $429,000 is pure compounding. That is money that worked while you slept, while you ate dinner, while you were on vacation. Scenario 2. Same $200 per month, but starting at age 30 instead of 25. Total contributed $84,000, only $12,000 less. Result at age 65. Approximately $364,000. Those 5 years of delay cost you $161,000 in final wealth, for only $12,000 less contributed. That is the cost of waiting. Time is the most powerful financial asset you have. The second best time to start was yesterday. The best time is today. 1. Open your Fidelity, Schwab, or Trade Republic account. 2. Go to automatic investing. Set up a recurring buy on your chosen ETFs. 3. Link it to your paycheck deposit. Invest before you have a chance to spend it. 4. Set it, don't touch it, let compounding do the work. Automation removes willpower from the equation entirely. Just like we did with the emergency fund in episode 2. I made most of these mistakes myself. Here they are. Learn from me so you don't have to learn from your portfolio. There is no perfect time. Markets recovered from the 2000.com crash, from 2008, from the 2020 pandemic, from the 2022 bear market. Every single time, the cost of waiting is always higher than the cost of imperfect timing. Even professional fund managers, with entire teams of analysts, underperform broad index ETFs over long periods. You don't have inside information. You don't have a team. Index ETFs are the evidence-based choice. Build your ETF foundation first. Individual stocks can come later if you want, with money you can afford to lose. When the market drops 20 to 30%, it feels like the world is ending. That's exactly when most beginners sell, permanently locking in their losses. The investors who hold through downturns are the ones who capture the full recovery. Write this somewhere visible. Market drops are sales on stocks I'm buying anyway. An ETF with a 1% expense ratio versus 0.03% looks like a tiny difference. On $100,000 over 20 years at 7% return, that 1% difference costs you roughly $30,000 in lost compounding. Stick to low-cost index ETFs from Vanguard, Fidelity, or Schwab. All under 0.05%. Checking your portfolio daily creates anxiety, triggers emotional decisions, and adds zero value to your returns. Your job is to invest consistently and review your allocation once a year. The more boring your investing behavior, the better your long-term results. That's not a metaphor, there's actually research on this. Just like the 30-day savings sprint in episode 2, I want to give you something concrete. Not just strategy, action. Here's the Set It and Grow Challenge. Week 1. Open your account. Choose your platform from Chapter 2. Open your Roth IRA or Brokerage account today. It takes 10 to 15 minutes. No excuses. Week 2. Make your first investment. Fund the account with any amount, even $50. Buy your first ETF. Portfolio B works for most people. Done. You are officially an investor. Weeks 3 through 12. Automate and ignore. Set up automatic monthly contributions, whatever your budget supports. Don't check the account more than once a week. Let it run. Post your account opening in the comments. Drop your target, $1,000, $5,000, $10,000. I read every single comment and I'll shout out the most dedicated investors in episode 4. Let's recap what we covered today. The Roth IRA is the most powerful account for most beginners. Always prioritize it first. Open a zero-fee account. Fidelity for the US, Trade Republic for Europe, GBM Plus for Mexico, XP Investimentos for Brazil. Build a simple 3 ETF portfolio, VTI, VXUS, and BND, mixed by risk tolerance. Use dollar cost averaging. Automate fixed monthly contributions and never stop. Avoid the 5 beginner mistakes, especially panic selling during drops. Do the Set It and Grow Challenge. Open your account and make your first investment this week. Your 10-minute action plan, right now, after this video. 1. Choose your platform from Chapter 2 based on your region. 2. Open your Roth IRA or Brokerage account. It takes 10 minutes. 3. Pick your portfolio, A, B, or C from Chapter 3. 4. Download the free beginner investment tracker, link in the description. 5. Make your first investment, any amount, and set up automatic contributions. Next week, we tackle a question I get in literally every comment section. Frank, should I pay off my debt first, or start investing? Debt versus investing. The exact framework for 2026. We'll give you a decision tree that tells you exactly what to do based on your interest rates, debt type, and financial timeline. No more guessing. Make sure you're subscribed and hit the notification bell. Practical strategy, every week. No filler. I waited 4 years too long to start investing. That cost me $30,000 in potential gains I'll never get back. But I'll tell you what. The day I made my first automated investment, $100 into a Vanguard index fund, something shifted. I stopped feeling like money was something that happened to me, and started feeling like money was something I was directing. That feeling is available to you today. For $50, for $100, for whatever amount you have right now. Open the account, make the first investment, start today. See you in the next one.